Let's look at a ledger. On the left side, we have the American dream, fueled by two modern professionals. Let's call them Marcus and Elena. Marcus is a software engineer. Elena is a project manager. Together, they bring in $140,000 a year. Statistically, they are doing better than 80% of the country. They check every box of success. Degrees on the wall, 2 cars in the driveway, and a home in a zip code with an 8 out of 10 school rating. But if we look at the right side of the ledger, the side nobody talks about at dinner parties, we see a different story. They have $4,000 in checking, $12,000 in credit card debt, and a distinct gnawing panic in their stomachs every time the check engine light turns on. They are exhausted, they are overworked, and they are broke. If you are watching this and thinking, I make too much money to feel this poor, you are not crazy. And more importantly, you are not bad with money. You are caught in a structural economic phenomenon that has been quietly dismantling the middle class for 40 years. We call it the two-income trap. Most people think the two-income family is the pinnacle of financial security. It sounds like basic math. $50,000 plus $50,000 equals $100,000. Double the money, double the safety. But that is not what happened. Today, we're going to look at the cold, hard data on why two-income families are actually more likely to go bankrupt than the single-income families of the 1970s. We're going to look at how the cost of the good life has fundamentally changed and how race and systemic factors make this trap even harder to escape for some than others. To understand the trap, we have to travel back to 1970. In the early 70s, the typical middle-class family had one earner. They spent about 50% of their income on fixed costs, the mortgage, the car, the health insurance. The other 50% was discretionary. It was margin. Today, the typical dual-income family spends 75 to 80% of their combined income on fixed costs. Where did the money go? The popular narrative is that we spent it on lattes, iPhones, and giant flat-screen TVs. We are told we are a generation of narcissists who can't save. That is a lie. Elizabeth Warren and Amelia Warren Tyagi crunched the numbers on this decades ago, and the data has only gotten starker. Families today actually spend less on clothing, food, and appliances, adjusted for inflation, than families in the 70s. So where is the money? It went into 3 things: housing, healthcare, and childcare. Let's talk about childcare. In the single-income model, childcare was free. It was provided by the stay-at-home parent. Today, according to 2023 data from care.com, the average weekly cost of a nanny is $736, and a daycare center is $284 per week per child. If you have 2 kids in daycare, you're paying a second mortgage. In fact, in 34 states, the cost of childcare exceeds the cost of in-state college tuition. Then there is healthcare. Since 1970, healthcare spending per person in the U.S. has grown by over 2,800%. Even with insurance, the deductibles and premiums eat away at that second paycheck before it even hits the bank account. But the biggest devourer of wealth? It's the house. And this is where the trap gets sophisticated. Why does a modest 3-bedroom ranch house cost $600,000 today? It's not because the house is made of gold, it's because of the school attached to it. In America, we don't buy homes, we buy school districts. In the 1970s, with only one income to play with, there was a ceiling on how much a family could bid for a house in a good neighborhood. When women entered the workforce en masse, a massive victory for equality and autonomy, household incomes doubled, but the number of houses in good school districts didn't double. So what happened? Families didn't pocket the extra money, they bid against each other. The two-income family next door bid $300,000, so you had to bid $310,000. We poured our second incomes into the ground, driving up the price of real estate to the exact limit of what 2 people could afford. This bidding war affects everyone, but the data shows it hits racial groups differently, compounding the difficulty of the trap. According to the Federal Reserve's 2022 Survey of Consumer Finances, the median net worth of white families is roughly $285,000. For black families, it is roughly $44,900. For Hispanic families, it's about $61,600. Why does this matter for the two-income trap? Because when a white middle-class family stretches themselves to buy into that expensive school district, they often have a silent partner. Intergenerational wealth, a down payment gift from grandma, or a safety net if they lose a job. For many black and Hispanic families who have been historically excluded from housing wealth through redlining and predatory lending, there is no generational safety net. In fact, high-earning minorities are often the safety net for their parents and extended family. So when a black dual-income couple stretches to buy that same house to give their kids a good education, they're walking a much tighter rope. One layoff, one medical emergency, and they have zero margin for error. The trap snaps shut faster and harder. This brings us to the scariest part of the theory, the loss of the safety valve. In the old single-income model, the non-working parent was the ultimate insurance policy. If the dad lost his job, the mom could get a job to keep the lights on. If a child got sick, the mom was already home to care for them, saving on nursing costs. If the car broke down, you didn't need it to get to work immediately. In the modern dual-income model, you have no backup. You have no bench players. Both adults are on the field, running at 100% capacity. If one person loses their job, the household income drops by 50%. But because you bought a house and lifestyle that requires 100% of both incomes to service the debt, you cannot survive on 50%. You default. This is why families with children are the fastest growing demographic for bankruptcy. We assume bankruptcy happens to people who gamble or buy Ferraris. No, it happens to parents who are trying to keep their kids in a safe neighborhood. Let's look at the second income math. It's brutal. Let's say the second earner brings in $50,000. Number one, taxes. That money is taxed at the household's highest marginal rate. Let's say 25% goes to the IRS and state taxes. You're down to $37,500. Number two, childcare. Average for 2 kids, let's be conservative and say $20,000. You're down to $17,500. Number 3, commuting and second car. Gas, insurance, repairs for the car needed to get to that job. Average, roughly $5,000. You're down to $12,500. Number 4, work expenses. Wardrobe, lunches out, convenience food because you're too tired to cook. Roughly $3,000. That $50,000 job is actually netting the family $9,500 a year. That is $182 a week. Is it worth the stress? Is it worth the exhaustion? For many, the answer is we have no choice. And that is true, because the mortgage is already signed. So is the answer to send women back to the kitchen? Absolutely not. That is regression, not a solution. The goal is financial autonomy for everyone. The answer lies in how we structure our financial lives before the trap closes, or how we pry it open if we are already inside. We need to redefine what affordable means. Banks will tell you that you can afford a mortgage that takes up 45% of your gross combined income. This is a permission slip for bankruptcy. The solution is the one-income ratio. If you are a two-income couple, your goal should be to keep your fixed expenses, mortgage, utilities, car notes, insurance, at a level that can be covered by one person's salary. I know, that sounds impossible in today's housing market, but let's look at the trade-off. If you live on one income and save the second, number one, you are saving 50% of your household income. You will reach financial independence in 10 to 15 years, not 40. Number two, you regain the safety valve. If one partner loses their job, it's an annoyance, not a catastrophe. Number three, you regain power. When you don't need every cent of your paycheck to pay the mortgage, you can negotiate better at work. You can walk away from toxic bosses. The system is designed to extract maximum efficiency from you. It wants 2 workers per house, 2 cars, 2 commutes, and a mortgage that keeps you obediently working until you're 70. The Joneses you are trying to keep up with, they aren't rich. They are drowning. They are leasing luxury cars on credit and putting groceries on Visa cards. Don't envy them. If you are currently in the trap, feeling that tightness in your chest, start today. Look at your second income expenses. Can you downsize the car? Can you move to a slightly smaller home or a different neighborhood to free up $1,000 a month? It requires an ego check. It requires living smaller than your income suggests you should. But the peace of mind that comes from knowing you can survive a storm is worth more than any granite countertop or luxury SUV. Two incomes are a blessing, but only if you treat the second one as a bonus, not a baseline. If this breakdown helped you see your finances in a new light, hit that subscribe button. We're going to be diving deeper into how to retro-engineer your finances to escape these systemic traps in the next video. Don't just work harder, work smarter. See you next time.